Hi there everyone, good morning and welcome to this edition of The Market. I'm Avan Dabash, with me Nikunj Dalmia as well as Anisha Jain in our Mumbai studios. First things first, let's take stock of the markets, and in yesterday's trading session, it was a range-bound day of trade, pretty much touch and go with the 19,600 mark, wrapped up just a smidge below that level. It was the mid-cap index which managed to gain about 0.5% or so by the time we shut shop. And yes, that sore loser in trade continued to remain the PSU banks. After kicking off the year to a pretty solid start, the PSU banks were the top drags in the trading session. A lot of those, the PSU banking stocks, heavyweights like BOB, SBI, etc., they all succumbed to selling pressure. And for 5 straight days on the trot, you had the PSU bank index coming under pressure. And the notable factor, Nikunj, is that yes, we saw Pharma stand out, but the fact that FIIs have remained sellers for 8 straight days on the trot.
Savan, what looked like a stormy market, I think the storm exactly has not moved in the wrong direction. So yes, there was a bit of a mid-air turbulence same time last week, and it appeared that we could be headed for lower levels both for global markets and also for local markets. Thankfully, that fear has not translated into a brutal reality or ugly sell-off. That is point number one. Point number two, global markets are looking much more calmer than what they have looked. And I think in this kind of a market, it is safe to assume that there is just no point in preempting the market top. There is just no point in calling the market top. Let the market chart its own course, and then we'll talk about the direction. For me, what matters is that right now I expect the market to stay in a range, and the bias could be on the downside, given that at higher level now, the supply from the FI front seems to be emerging. For the better part of July, August, or better part of, I would say, June and July and August, you had no seller in the market. FIs were buying, DIs were buying, retail investors were lapping up stocks, and HNI investors were really participating with full gung-ho. Now, you would say that suddenly the FI selling has emerged, which in a sense could really make the market, it could really arrest the market rise. But for me, what matters is that I think the bulls, they really need to be patient. You need to be prepared for a range-bound movement. You need to be prepared for much more volatility. And I think it's too early to say that the market has topped out. However, I continue to maintain that in the near term, you're not going to see a rara flourish also.
Okay, not going to see a rara flourish in the near term. So there is some, a problem or pause that the market has hit for the time being, and the bias continues to be on the downside. That's the kind of market setup we have for us. And of course, FIs, as we have been pointing out, for the last 8 sessions on the trot, they have been on the selling side, a total of almost 10,000 crore rupees. Look at those red bars across the screen, right from a 4,000 crore sell to a 2,000 crore that we just saw yesterday. The FIs continue the selling spree, but what's been trying to negate all of this is the solid DII flow. As Nikunj was saying, they have managed to pump in almost 10,000 crore rupees, and those are the green bars for you. Yesterday as well, they managed to buy around 1,080 crores. Given all of this, in terms of the market dynamics as well, we have seen that a lot of stocks have managed to recover from the broader market, and one such set of stocks is the Adani group of stocks. This year, they have managed to show stellar recovery across the board. So whether you look at Adani Enterprises, Adani Green, Power, Port, they're all up almost, double from the lows of this year. Of course, it wasn't a great start to the year for the Adani group as it is, with that entire Hindenburg saga playing out. But Nikunj, it looks like finally the street is taking stock and kind of, diversifying the truth from what the allegations were. They're trying to decode their own decisions in terms of how the balance sheet is looking like, what the company is doing, and seems like that the confidence is coming back.
See, Anisha, the beginning of the year, after the run-up in 2021 and 2022, by any yardstick, these stocks were richly priced. Now, whether it was the impact of the Hindenburg report or the positioning of the market which led to the selling stampede, I'm not getting there. But what looked like a perfect storm for Adani group of companies, where markets raised a question mark on their inability to pay debt, the fact that foreign institutional investors were not very active, these stocks were very concentrated by a few group of investors. A lot of those fears now are coming to rest. First, after that big GQG deal, the fact that large long only funds have come back into Adani group of stocks, I think that is something which just tells you that there is appetite or there's global appetite for the stocks. The promoters, I think they've done a great and a splendid job in managing the cash flows in a difficult environment when the outlook from just about everybody in global rating agencies was negative. See, now that the balance sheet is in good shape, there is additional interest which clearly seems to be coming by more global investors, and if I'm referring to the QI deal yesterday. So from a market standpoint, the fear which in a sense had really hit the Adani group of stocks, that's clearly behind us. From a market standpoint, it is business as usual, and there is global interest which is coming back in individual interest that is visible in the way of some of the recent block deals have been done. I think the way now the stocks would move is that they were richly priced, then came the selling stampede, then comes the price discovery, and now I think the companies and the stock movement will be a function of how the companies would move. Look, these are different companies with different business cycles. While the big picture argument is that it's a bet on infrastructure, but each individual company, which in a sense in 2021 and 22 was moving in tandem with each other, that differentiation going forward I think should occur in. Now it would be a function of delivery, now it will be a function of cycle, now it will be the difference of expansion. So I do expect that now more than sentiment and flows, it would be the business and the earnings trajectory which would be deciding the course of the action. But you were referring to FIs. I think that is the single biggest story this morning. The question would ask us, and let's look at that data. What have FIs done in last 8 days? And what have DIs done in last 8 days? That's FI flows. In the month of August, ladies and gentlemen, 10,000 crore selling and DIs 10,000 crore buying. First question, why are FIs selling? And if they are selling, are they only selling in India, or this is more like a global phenomenon? I think this is more like a global phenomenon, if you frankly ask me. If you look at the outflows in China, in Taiwan, in South Korea, in Thailand, it's more like a global phenomenon where foreign institutional investors have sold. Could this continue? Very difficult to say that. But is there merit for Indian markets to see less outflows and more inflows whenever the tide would turn? The answer to that is yes. Just about every expert we've spoken to, they clearly are of the view that Indian markets, even though the opinion for India has changed, the positioning is still market neutral. Everybody is moving out of China and money is coming back into India. So really from an FI standpoint, I'm not that worried. But if there is a global risk of trade and a little bit of skim from the top happens in emerging markets, Indian markets will see outflows. The good bit for us is that DI mutual fund levels are high. New NFOs have kicked in. So whatever FIs are selling, I think domestic institutional investors are digesting it. But for me, what really matters is that there's all talk that, okay, FIs are buying and that's the reason why markets are going higher. I think Indian markets are no longer a one-trick pony. A, I don't expect the selling to continue. B, Indian markets are no longer a one-trick pony. And C, even if a global risk-on trade happens, I think India is going to be hit less.
Yeah, and it was interesting that you had that conversation just yesterday, Nikunj, with Jonathan Garner, the Chief Asia EM Equity Strategist at Morgan Stanley. And when you spoke with him about flows, he said that India should get accustomed to strong flows by institutional investors here on. Let's listen in.
If one looks at the global scenario, 2022, we saw mass outflows out of India to China. When we started the year, that pattern was at play. But since April, foreign institutional investors have come back into India, both by the portfolio route and by the FDI route. Do you think this could be a multi-year trend in making, and now we should get accustomed to strong flows by institutional investors, especially foreign institutional investors into Indian equities?
Yes, we do. What we now know is that the economic recovery in China has been very lackluster. And certainly there is a debate amongst investors as to whether it's reached an important multi-decade transition. Its demography is quite adverse, and that's in contrast with India in terms of the population age distribution. And that matters not just for themes like consumer, industrials, financial stocks, earnings, but it matters for the demographic that can now buy equities in India. So again, for China, the near-term issue around leverage and the property sector's issues is causing a real challenge for policymakers, and it is weakening the currency. Whereas on my recent trip to India in June, I was very struck just how strong the economy is across the board in manufacturing and services PMIs, and real estate transaction volumes and activity, in inward FDI and infrastructure construction. It's a very interesting story to us in India.
Very interesting story on India. That's the word coming in from Morgan Stanley. But what's the word coming in from our technical experts? Let's welcome on board Kunal Bothra as well as Naresh Mirani, as always, to talk to us about the technicals of the markets, rather. Kunal, let me start with you. Nikunj was talking about how 19,600 is becoming a bit of a sticky zone for the markets. Do you concur? And is there more downward bias than upward bias?
Well, yeah, I was expecting a very shallow kind of a bounce. So, in fact, on Thursday, Friday, when we were discussing, I mentioned that I would probably expect 19,650 as one of the higher ends where the markets can see a bounce into. Now, yesterday I was presenting a data for the indices in terms of option play, and there was a huge amount of writing at the 19,500 call, 500 put, and the 19,600 calls for the index for the Nifty. Now that indicates that we could be stuck into this 100-150 points band if you add the premium for both these strikes. Now, in fact, entire day yesterday, the Nifty and the Bank Nifty was stuck into a very tight range of 60-70 points for the Nifty and I think 100 odd points for the Bank Nifty. And I think that itself tells you that the action is more indicative that the markets or traders are expecting that the markets would remain into a range. Now, at the upper end of the range, as I said, is 90,650, to be precise 665 if you add back the premium of the 19,600 call. So that's the max upside which I would expect for the index over the next couple of days. And I would expect that possibly for this weekly expiry on Thursday, we could probably be trading into this band of 19,450 on the downside and 650 on the upside broadly. So I think that's the range which I would be playing out for over the next couple of days for the Nifty.
Morning, Naresh. Let's get in your thoughts as well as to how we wrapped up yesterday's trading session. What are the important levels that you're tracking?
So looking at it a broader base, 19,300, 400 on the downside, 19,700, 800 on the upside. We stick into this range and could continue for a week at least. And over the next 1 week, majority of the results would also be done on the broader market side as well. So we stay in this range. There are no major triggers as such. Global markets continue to be in a strong momentum. We've not seen a follow-up selling in the last few sessions. So the setup is to be more stock specific, sector specific if there are new rotations. But now is the time when it has to be more and more selective in terms of the approach to the markets, because we are getting into a consolidation which could stay much longer than we expect.
So let's get stock specific and discuss your top ideas, Naresh.
So starting off with the same one, which I continue to like, is Indecent Bank. The stock has shown good relative strength over the last two sessions. The stock is still at 1350 to 1450 band, where it used to be back in pre-COVID times in January to March of 2020. The stock is now setting up for a trending move, should see more momentum above 1450 levels. So buy at current levels, preempting that breakout. Stop loss at 1360, target price of 1550 to start with. Second is a buy on LIC Housing Finance. The stock saw day before a huge 5 to 8x volume jump up with price action. Yesterday also did dip lower but recovered back well to the highest point of the day. And if you look at the last 2 to 3 years, 440 has been a significant resistance for the stock. And the stock is trying to break that resistance in a big way. If this happens, it could be a multi-year breakout for the stock, which could take it into a fresh trend after a long time. Expecting an initial target price of 480, stop loss at 428.
Let's find out what the stock-specific strategy is from Kunal. And Kunal, what is it that you're looking at on the charts today?
So I'll suggest two buy calls. The first one is upon L&T Infotech Mindtree, classical breakout on the short-term charts, especially on the early time frame yesterday. The stock breaking past about 5,000, 5,020, 25 levels. So would suggest a buy, expecting 5,200 as a possible near-term target. Stop loss could be kept at 49.80. And Laurus Labs is also the other stock, had recommended this around 350 mark for a potential target of 400. The stock has crossed about that 400 levels. So I would...
One of the stock that Kunal Bothra likes. But then apart from that, there will be many stocks that will be in focus on account of news flow as well. And two such stocks are Godrej Consumer as well as HDFC Bank. Let's bring on board Soumit to discuss those as well as to what the news flow is and what the likely impact is going to be on the stocks today. Let's begin with Godrej Consumers. Soumit, it was a decent set, international volumes picking up.
Well, more than international, it was the India volume that has picked up. For the second consecutive quarter, the company has been able to report a double-digit volume growth. In the first quarter, it was 10%, and this 10% number, given the context and given the fact that all the other FMCG companies have reported low to mid single digit volume growth, appears to be very strong. But this is also on the back of the fact that the company's base quarter volume growth numbers were pretty much weak. Now, this growth that we had seen in the first quarter was broad based, with home care volumes growing in double digit and personal wash volumes which grew in high single digit in the first quarter of FY24. On the margins front, if you see the gross margin, now that expanded by nearly 720 basis points as in the first quarter, it realized the full benefit of the lower raw material prices that the company had in the first quarter. And for the entire financial year also, if you see, the company has said that they are maintaining their EBITDA margin guidance. Now, given the fact that there was a 720 basis points expansion, still they are maintaining their margin. This could be because of the fact that again raw material prices have started to inch up from the second quarter. When it comes to the acquired business, now in the first quarter there was a loss, but the management is still confident that they will be able to clock high single digit EBITDA margin in the full financial year, that is FY24, and their revenue for this acquired business is expected to be flat. Moreover, the company has also announced a capital expenditure plan of close to 900 crore rupees. Now, all this, given the fact that they are looking to increase their ad spend, shows that they are prioritizing over long-term and strong volume-led growth going forward.
My only thing is, it's a sector which is not in focus. It's a sector where you would say that you're not in that bent of the market where you want to go back to FMCG, because you're in the bent of the market where either you're going towards financials, you're going towards consumer tech, or you're revisiting, in a sense, pharmaceutical. There are sectors where next 2 quarters, the recovery trade, I think it's in pharma. The extension trade, I think it is there in banks. And the void or the contra trade, I think, is in IT. FMCG is pretty much a sector which does well when markets are bereft of any trigger. Now, Godrej Consumer has gone through its ups and downs, and now I think it's too early for anybody to pass a judgment call purely based on the core business. Somit, that's my view, because the Raymond acquisition kicks in. How are the synergies matching? What are they able to do? While they have exhibited leadership, but they've got a whole host of global businesses which may be volatile. It's not very cheap, so the downside gets limited. They've had ups and downs in quarters, so I think markets will like what they've reported. But to pass on a verdict at a time when the Raymond's acquisition is going through, I think you'll have to wait for 2 quarters more. That's my limited point.
Makes sense.
Okay, that's the view coming in on Godrej Consumer. But the other stock as well that we'll be keeping our radar is what is going to happen with HDFC Bank as well. Remember the merger of the parent HDFC and HDFC Bank as well. You've got the FTSE Emerging All Cap Index has seen the investability weight of HDFC Bank growing to about 1.5%. And Somit, in the spotlight today, because the changes are going to happen in 3 tranches.
Well, to put it very simple, because of the merger, the weightage and free float has increased, and this was expected, but there was still some uncertainty. But given the fact that now the announcement has come in, it's pretty sure that there would be inflows, and in the September, and it will be done in 3 tranches, September, December and March 2024. The first will happen on August 18th, the announcement will happen, and September 15th is when the adjustment is expected to happen, and inflows are expected to be around 500 to 550 million US dollars, and over the 3 tranches it could be around 1.5 billion US dollars, which is a substantial amount for HDFC Bank at this moment, if you see. Also, given the fact that HDFC Bank is the only stock in the Nifty Bank Index that is expected to give the highest return potential over the next 12 months. Now, given the consensus target price, if you see, HDFC Bank's return potential over the next 12 months stands at close to 24%, which is the highest among the private banks. And this potential inflows is expected to be around 500 to 550, and over the next 3 tranches, it could be around 1.5 billion US dollars when it comes to HDFC Bank.
Okay, so highest return potential 24%, Nikunj, but do you think it's going to happen in a jiffy? The flows will have a bit of a support for the stock because it's been in a bit of a slumber.
The flows will be divided in 3 tranches. So that's 500 divided by 3, that's about $150 million. $150 million is not like...
it's actually 1.5. In the September, it would be under 500 million.
It will be 500.
So 500 million approximately
500 is a lot of money.
Yeah.
500 for...
1.5 billion over 3 tranches.
Okay, so my bad. So 500 I think is a very large number looking at considering the volumes what they have right now.
Around 1.812x.
Exactly. Now the point is, this is a stock in the short term will be a function of liquidity. There's nothing new in terms of a trigger. There's nothing new in terms of news flow. There's nothing new in terms of management guidance. There's nothing new in terms of how the process of merger would go through. In the short term, this stock is a function of what will happen to the flows, and I think flows are going to be strong. Be rest assured that HDFC Bank, which you would argue and say it's been an underperformer, but because flows, and once the technical factor they get over, it will start outperforming. Typically, I've seen in the past when such kind of news comes out, it tends to have a 2 to 3% impact on the stock. It's not like a 5% move or a 10% move. 2 to 3% impact sentimentally it happens. When the actual flow comes in, they tend to balance it out. So this may just give you a fillip in the near term. This is not going to be like a liquidity or a short squeeze event.
Yeah, so not a big trigger, but just something which will support the prices.
Absolutely. All right. Thanks very much, Somit, for giving us those stocks to watch out for in trade. But we've been interacting with top market veterans on the channel and wanted to understand from them which are some of the most underrated and overrated sectors in the markets. Let's hear out some big voices.
Point is that longer term, these stories will play out perfectly. In fact, the new age companies that we own as such. But so as I've said earlier also on your channel, what do you look for in a platform? Basically, these are all platform companies. They offer a platform which gives you convenience. Is that an option of converting? I mean, caching that convenience? Yes, right. If there is, are there enough users for this convenience? Yes. But is it easily replicable? I think that is the last question that you need to answer, which has to go in the negative rather than the affirmative. If that is the case, then you want to own that company, and that's why we believe that the ones which we own are fairly non-replicable as such.
Pharma continues to be a defensive bet, but unfortunately, there is no single sector-wide trigger, either positive or negative for the sector. So to that extent, we will have to evaluate stocks from a bottom-up perspective and then take a call. Yes, in a market which has gone up quite well in the last 4 or 5 months, we have not seen pharma really participating to that extent. And anyways, pharma has been an underperformer for the last couple of years as well. So to that extent, there is a relative valuation comfort there, but there is no single trigger that can take the entire sector up in our view. So you will have to evaluate them separately.
If you look at it in absolute terms, you might not get that indication that it's going to bottom out, and there are definitely some headwinds. But if you look at the IT index divided by the Nifty, it is at a 10-year support. And I think after Infosys results, a lot of the negatives are already in the price. People are factoring in the headwinds that's coming out of the US and the global markets in general. And we, any which way, live in a very dynamic world. But chartically, I feel that it can only get better from here. But it's not going to be a holistic rally. It's not going to be a rally across the board. So within the top 4, top 6, the ones that we like are TCS and Tech Mahindra. And I believe that these two stocks will stand out and will outperform the IT index. On the other side, if you look at mid-cap IT, there is this digitalization, AI theme-led rally which is taking place across the board, which I think is not going to die down.
Welcome back. And more stocks which will be in focus today. Manappuram Finance will be in focus because its arm, Asirvad MFI, has reported better than expected numbers in the quarter gone by. NII, PPOP jump on a YOY basis. Vamakshi is joining us with more details. Hi Vamakshi, good morning.
Well, yes, Manappuram Finance is in focus on the back of the numbers that were reported by its subsidiary Asirvad Microfinance. Definitely, the numbers were much better than what the street was penciling in, and in fact, this is important because the Asirvad, the MFI, actually accounts for nearly 26% of the advances mix. Let's quickly look at the numbers. When we look at the net interest income, that has come in nearly 90% higher on a year-on-year basis. PPOP is also seeing a very sharp jump up. In fact, it has more than doubled from 108 odd crores to 257 crores. The net profit the company has reported this time around stands at 111 odd crores, and this is against a loss of nearly 8 crores that the company reported in the same quarter last year. Provisions, however, have come in slightly than what the street was penciling in. Provisions have gone up by nearly 61% on a quarter-on-quarter basis. So all in all, across the board, the company has reported numbers that were much better than what the street was penciling in. But when we look at the asset quality, that has seen a bit of a deterioration. When we look at GNPA, that has marginally increased from 2.8% to 2.89% on a sequential basis. Other than that, we we also saw that the subsidiary completed its rights issue of nearly 150 odd crores at the end of Q1 FY24, and as a result, the capital adequacy has now improved from 19.7% to 22.6% on a sequential basis. So all in all, a good set of numbers that have come in from Asirvad MFI, and that is the reason you should definitely watch out for Manappuram. Now keep in mind that the company is expected to report its numbers on August 10th.
All right, thanks very much for giving us those details, Vamakshi. Moving right on then, let's hear it out from Vineet Bulinchkar of Ventura Securities. What's his top fundamental stock idea? Let's listen in.
Welspun India is one stock which is out of the radar for everybody. And I think that stock has the potential to do exceedingly well over the next 5 years. My reasoning being that the home textile business has got back its margins again. If you see their B2C business is clocking along quite nicely. Towels, bed linen, as well as their wooden flooring business is coming along very well. Their capex cycle is over. We are going to expect margins going to between 10 to 15%, EBITDA from zero as of now. And the way their B2C platform is building up in the consumer discretionary space, I think there could be a very, very sharp re-rating on this stock. Not to forget, that they would also be debt-free by then.
Okay, moving on, let's see what's happening with respect to the policy action. Indian companies have raised almost 10 lakh crore rupees in FY23 from the markets, shows the SEBI data. The regulator proposes to review eligibility criteria for introduction and continuation of certain stocks in F&O segment. My colleague Ankur Mishra is here with more details. Hi, Ankur.
Yes, SEBI annual report has highlighted various policy changes, and one of them is, of course, the F&O eligibility review. Now, in this, the market regulator has proposed to review eligibility criteria for introduction as well as continuation of stocks in F&O. Right now, what happens is there have been certain complaints which have said that the eligibility criteria is not proper. In fact, many of the listed companies have said that they are not included in F&O despite the criteria being fulfilled. So there is going to be a review in this process. And if you recall, the last review of like this was happened in 2018. Apart from that, there has also been suggestions on disclosure from unlisted companies. And this has been done to review and standardize the disclosures in public offer documents, and that is issued by private and listed companies. Apart from that, the data has also been mentioned about the higher capital raising in FY23, which has been to 9.8 lakh crore, and higher. This is higher than 4.6% if you compare with last year. Apart from that, there has also been a suggestion to implement mutual fund light regulation. Now, this is something which ET Now had earlier reported in May about these regulations, and this will reduce compliance burden as well as it will foster innovation for mutual funds.
All right, thanks very much for giving us all of those latest updates from SEBI. Let's move right on then and connect with Deven Choksi, who's now joining in on the show to share with us his outlook on the markets. Deven, thanks so much for taking time out. Let's begin then by getting your take on Hindalco, Coal India, Adani Ports, lots of numbers that are expected later today. Are you working with any expectations in particular for Coal India and Hindalco?
Yeah, Irfan, good morning. Particularly for Coal India, I think the numbers are likely to be on a higher side, largely because of the fact that I think the volume numbers, I must say, I think are likely to be on a higher side due to the fact that I think higher production is now sustaining at elevated levels. Maybe I think the price in the open auctions, I think, has also affected better realization. To a greater extent, I think that should also get reflected positively into the numbers of the company. So overall, I think the balance sheet, I think, looks, I think, relatively more positive than what we have seen up till now in case of Coal India. And that's where probably one could possibly argue for relatively better numbers and the profits hereafter.
Sure. Deveen, what's your take regarding the pharma space? The earnings have been really solid this time. Overnight, of course, even Torrent Pharma, Gland Pharma managed to surprise positively. Are you looking at any of these names?
Well, I think the companies in pharma where the specialty generic products portfolio has started showing relatively better amount of profit margins for those companies which includes likes of Cipla, likes of Sun Pharma. I do not know, I think, whether the mid-tier companies are equally well placed as far as I think higher amount of profitability is concerned. Maybe I think the issues which bothered them in the previous quarters, I think those issues are out of the way and they should be reflected well with the current quarter's numbers as far as the business is concerned. Maybe I think some amount of margin improvement in respective cases, I think one could possibly argue for. Also because of the fact that the raw material prices, particularly I think the chemical prices have remained on a relatively softer side in this particular period. So overall, in line with the trend in most of the pharma companies' numbers, you should be seeing relatively better performance coming in from many of the mid-tier pharma companies as well going forward. But we stay largely focused on some of the larger companies like Cipla and Pharma, where we see the sustainability of higher amount of growth, including Dr. Giri, of course. I think sustainability of higher amount of growth for the of the business in times to come.
All right, let's put the spotlight on PB Fintech as well, as it came out with its numbers, and you did see that sharp contraction in the net losses to just about 12 crore rupees from last year's 204 crores. And this is coming on the heels of Zomato as well, reporting a pretty healthy set of earnings. Just wanted to get in your thoughts, Devin, as to what the outlook is now that we are seeing improved financial metrics as well.
I think one of the most important factor which is happening in most of the companies, I think the technology-led businesses, including this fintech company, I feel that I think the larger amount of focus is now onto the profits and the profitability vis-a-vis acquiring the market share and generating higher amount of turnover, which is fundamentally a very positive news. I think this is where probably tightening of the money supply has helped, I think, some of these companies to come up with a true character in which I think they are. In my viewpoint, I think this is a beginning probably of higher amount of I think profit contribution coming in from these companies. In my viewpoint, I think these particular numbers will have to look upon I think in a little bit more systematic manner. Somewhere you are likely to see, I think, the changes in the revenue model in respective companies without getting into specific for our company. I would say, I think, in general, the revenue model is getting shifted to the higher amount of contribution coming into the profit. So overall, one should remain positive. However, looking at the capital employed in the business, I think one cannot argue for the valuation at this point of time. But since the loss-making proposition is out of the way, I would think that the business of this company should look reasonably steady going forward for the investors in the portfolio.
Yeah, and talking about the focus on profitability, that's quite evident by the latest move coming in from Zomato, where reports have been suggesting for the last few days that the company has started charging platform fee of ₹2 per order, and this is happening only for select users in select market. But nonetheless, it could have a very positive impact on the profitability of the company, because remember, Swiggy had started charging platform fee back in April 2023 itself, and there was no major impact as far as the market share loss is concerned. So this platform fee will directly flow into the EBITDA and profits without material cost. So that means the operational profits will get that fillip and boost. In fact, analysts are penciling in that additional fee could boost the food delivery adjusted EBITDA by as much as 40 crore rupees per quarter. So that will give a lot of really support on the bottom line. So let's see how it pans out. But for now, an incrementally positive news coming in for Zomato as well. So we'll watch out for that. Separately, Devin, what's your take regarding Britannia and Godrej Consumer? Because overall, the FMCG numbers were a bit subdued, a bit muted versus the expectation, though at least Godrej Consumers has managed to outshine a bit. What is your top bet in this vertical?
So I think on one side, we are seeing the more amount of I think focus coming in on two counts. One, because of the lower input cost, I think most of these companies are relatively better off in this particular quarter. On the other side, actually the turnover of the company is reflecting a larger amount of sales directly going into the retail shops. As against earlier, the bulk turnover which used to get reported at the distributor level Now I think the turnover getting reported is at the retail shop level, which is again I think very important aspect because there is some amount of change which we are experiencing in this particular activity. As a result of which hereafter you might see I think the turnover which is basically genuinely executed turnover, which is fundamentally more important because now the companies are basically also having the point of sale integration which is happening with their central warehouses, which probably allows them to even do the demand projections of particular products in particular territory or region. That allows them to, I think, do the production rationalization. At the same time, I think the improvement in the logistics, which results into better efficiency and better margin for this company. So I'm more particularly looking at the subject of companies getting the advantage of better efficiency, better rationalization of sales, and predictability of sales using the AI platform in likes of HUL and others. So we remain positive in this space. Britannia definitely I think looks relatively more positive. Given the kind of strength the product portfolio that is demonstrating, we think that I think higher the penetration, they would have relatively better opportunities going forward in showing higher performance on a sustainable basis.
Naresh, let's get some chart checks going. Here were buzzers in trade yesterday. You had an HFCL that saw a sharp rally, nearly 12%. What's the view on the charts? And also, have you had a look at Ircon International?
Yeah, so if you look at HFCL, it was more driven by the announcement, and that has been the case yesterday for a lot of these companies. A lot of cable stocks, a lot of optic cable stocks also did well. So would consider it to be a one-day move. Wait for it today if it can follow up or say fades off again. So no view out here. We'll wait it out. Ircon on the other hand looks interesting. The stock has been in a uptrend. Did a consolidation around 80 to 90 levels for 2-3 months and then started a fresh uptrend. Now this is a case where it becomes difficult to buy when the stock has already moved up, say from 80 in 2-3 weeks to 101. So if somebody has a position, a trading stop loss now comes at 95. Even a fresh position implies a stop loss of 95. We've seen momentum continue in a lot of these railway names, so this could also continue on the upside. And the only way one can write it down is with keeping a trading stop loss.
Okay, it's been chugging along the entire railway sector and the momentum is likely to continue. But time now to hit a pause as far as the market discussion is concerned and welcome a corporate on the show. We have with us Dr. B Bhaskar Rao, the Chairman and Managing Director at KIMS Hospital, to talk to us about their numbers because it was a decent show. The revenue went up by 22% on a year-on-year basis, though the EBITDA jumped up by around 14%, and that's because the margin slipped by almost 200 basis points on a year-on-year basis, coming in closer to around 26%. And that's exactly my first question, Mr. Rao. The margin slipping, was there a one-off in this quarter, or is it likely that 26% is going to be the new range going forward for EBITDA margins?
This is one of this quarter because this quarter, the first quarter is always a lean period because of the holidays and many people go for it. Most of the electives, they postpone it. So usually every year, this quarter is a lean quarter. But in spite of that, we could able to achieve the highest the top line and as well as the good growth in the EBITDA.
So, Mr. Rao, you've added a couple of facilities as well. I think your Visakhapatnam facility got on board. You're launching more in Nagpur as well. Talk to me about what kind of numbers are you expecting from these facilities?
No, both the things in Nagpur and as well as the Sunshine facilities, they are shaping up as we expected. Little bit delay of one of the Sunshine facility we want to shift to the new facility, that is getting delayed about 4 to 5 months. Because of that, still they would have been, we didn't get the expected growth. Definitely in the second and third quarters, there will be a lot of improvement in the Sunshine facilities concerned. And Nagpur, we have been put a lot more new consultants and new therapies in that. They just started about this last quarter. So that we can able to see the expectations in the next 2-3 quarters. So as we expected, and we are doing well, and there is no any sort of a disappointment to us.
Sure, Mr. Rao, but given the fact you are saying that Q3 and Q4 will see incremental revenues coming in from these new facilities, what would be the annual growth run rate looking like? Because already in this quarter, you managed to clock a 20% plus growth. For the entire year, are you targeting what, 30% plus kind of growth?
It will be definitely better than what we have shown as of now. In the second and third quarters and fourth quarters are going to be more promising. Definitely, we can expect between these two, 20 and 30. Definitely, there is a good growth.
Sure. So 20 to 30% growth rate is what we're expecting, but the occupancy levels, they are likely to stay northwards of 70% itself, and any improvement in the average revenue per bed, etc. kind of metrics?
There may be a little bit improvement on the occupancy rates. As of now, it is around 70% because when we shifted to the new facility of Sunshine is building up, there may be, it is almost right now less than 40% is the occupancy. So once it adds, and that will definitely, the occupancy rates will go up a little higher than what we are today.
So Rao, just quickly and lastly, wanted to get a sense from you whether the large part of growth will continue to come organically, or are you looking at inorganic opportunities as well? Because I think there has been a bit of delay when it comes to your Nashik facility, etc. as well. Would you like to make some inorganic acquisitions as well?
We are always looking for the inorganic as well as the organic growth. The Nashik facility actually is not get delayed. It is only 2-3 months. That is, as usual, anything on the construction and the statutory things are expected as we expected. There are so many holidays, the rains and all those things will be factored. So I think it is not much delay. And definitely we are also looking for both organic and inorganic in the next few quarters. That will also jump up the growth than what we expected.
Appreciate your time, Mr. Rao. Thank you for joining us on ET Now and sharing with us your business outlook. Let's move on. Stocks on the editor's radar, and today it is Tech Mahindra in the spotlight. The stock is about 35% away from its life highs, but the general consensus seems to be a negative view. Even in terms of valuation, it's the cheapest among the IT stocks.
Could Tech Mahindra be the special situation stock of 2023? That's what markets are betting on. Now, how do you understand that? Well, the only way to understand is that who are the people who are running the company and what is the new talent acquisition which is happening. We know that the CP Gurnani era is changing. There is a new CEO. Now the media is also reporting that there is a new COO. So Morgan Stanley has got a comment based on the media report that if there is a new CEO and if there is a new COO, which is Chief Operating Officer, could that combo be the turnaround combo for Tech Mahindra? This is one company of the Mahindra group which frankly has not turned around. It has a lot of potential, and Tech Mahindra was never in the big boy league. It was never in the top 4 or 5 in terms of the size, in terms of the margins. Can it be the turnaround candidate? Do they have the necessary tailwinds right now? So it's assumption. There is no proof. Numbers were good, but now can there be a change at play for Tech Mahindra? Very few companies, have that kind of a positioning, Avan. Now you think about it. Salil Parekh, Vishal Sikka, and the growth trajectory of Infosys, entirely different. Similarly, you look at Rajesh Gopinathan and Chandra when he was running TCS, the growth trajectory has been entirely different. In the case of Wipro also, when the current CEO Henry just came in, there was a big change which he was able to brought about, but then again Wipro has fallen flat. So there are a lot of these individual factors which also matter in a sector like IT. So with Tech Mahindra, I think that really could be the case. Could that really be the surprise candidate for the Mahindra group? That time will only tell, but are they putting up the building blocks, and is the valuations good enough? That is there a probability? See, I don't know about possibility. We only work in the realm of probability. Is there a probability? I will not rule that one out.
Okay, and with all of these key triggers in place, wonder whether this is going to be, Anisha, that special situation stock within the IT space.
Well, definitely a candidate to be a dark horse of sorts in the sector, given the fact that the earnings have been rather weak. But the big question is, has it bottomed out? And probably there's only upside from here on. Devin, what's your take? The stock has been doing pretty much all right. It's up 17% this year itself, despite the weakness we have seen in IT sector. Would you be a buyer in Tech Mahindra?
Well, some sort of conviction is coming in largely because of the fact that I think there are two important things which are happening in the universe. One is artificial intelligence and generative AI along with. At the same time, I think you are having higher amount of cloud computing demand coming in. Because of these two areas, probably the services sector in IT business particularly, I think is going to remain in demand. That is how I look at it. Maybe I think in initial quarters of this financial year, I think we have seen slower offtake of orders in most of the cases, which I believe is likely to accelerate once we see the stability coming into the rate hike cycle. in US economy. That is where I am relatively more confident about that Indian IT companies model is very well positioned. Look at Tech Mahindra. They have been hiring people in the area of AI and also in cloud computing. And that is where I believe that I think they are in the right direction. Their program pertaining to the BFSI sector, pertaining to the manufacturing sector, pertaining to the retail sector. In each of these verticals, I think this company has been systematically focusing on. So maybe I think as Nikunj was saying, I think the most of the companies are trying their best at this point of time in putting the right strategy forward. Maybe the results are likely to be seen. At least I think that the strategies are right. Results I think to be seen going forward, and we'll have to keep on watching this particular space. We believe that I think there is a good amount of potential here, but we'll continue to watch this space. I think on an increasing basis every quarter hereafter.
1183 is Tech Mahindra. In this year, it is up 16%. Let's look at the IT index in this year. Let's look at Infosys this year. Let's look at, even for that matter, Wipro this year. IT index 7. It has done much more than the IT index, basic benchmark. Infosys down 7. Wipro, TCS, the other IT companies also. Wipro up 4 only. TCS up 7. So Tech Mahindra, Naresh, has outperformed within an underperforming sector.
So if we look at it in the near term, yes, but if we see the extent of the correction which it has seen from 2021, that has also been large. So the stock was almost 1800 to odd levels back in end of 2021, start of 2022. And from that point of time, we are at 1180. The good part is it's gone through a sideways consolidation for the last 1 year. It bottomed out around June of last year at closer to 1000 levels. And multiple attempts were made around 1150 to 1200 over the last 1 year. We went above it and then we saw a gap down also. We are back to that same price of 1150, 1180. So structurally things look like it is making a basing out formation and eventually could slowly and steadily head up. So looks one of the more promising charts in the large cap IT space. So looks interesting, would be a buy at current levels, would have a stop loss at 1090 and slowly and steadily would expect a recovery towards 1400 mark on this one.
Okay, so the other stocks that were moving around in a trading session yesterday, of course, was Paytm. That's a massive surge. And the other breakout candidate was Max Healthcare. Now, overnight, the numbers have come out as well. But Kunal, on the charts, Max Healthcare and Paytm?
So Max Healthcare specifically, I think it's a bounce from the major oversold regions for the stock price. Over the last 1 month, the stock had fallen from I think 620 to 520.25, which was the low for the stock price. And the last leg of sell-off from I think 550 to or rather 575 to 525, that sell-off was very, very aggressive and it was on the back of some higher volumes. Indicators were oversold. I remember I think the RSI was almost single digits for the stock in the hourly charts. So what we saw yesterday was a bounce in the process of the stock getting extremely oversold. I don't expect the stock to get into another strong uptrend like what we saw yesterday. In fact, there could be a chance that the stock may try and get into a staggered downtrend going forward. You know, the real bottom typically happens for these kind of stocks when they double test their previous support. So I think a retest of that 525 mark, and if it's successful and the stock doesn't break below those levels, that could be a classic case where the stock may see a strong bottom formation. Would not be preempting a buy till the stock gets into that double bottom formation for Max Healthcare.
Okay, so that's the take coming in as far as Max Healthcare is concerned as well. A quick couple of chart checks as well, Naresh, from you. Indigo Paints, very solid set of numbers coming in, outpacing the industry when it comes to their volume growth. And the other one is Tata Chemicals. Of course, the margins have improved, but then there is that pricing pressure that stock has been dealing with. So on the charts, Tata Chemicals and Indigo Paints?
To a one-way downtrend after the listing. The stock bottomed out around 1000 odd levels in March, April and has recovered 50-60% from those price points. But in the whole of 2022, the stock had almost 4 to 5 tops around 1700. So it would be difficult for the stock to cross 1700 levels in the first go itself. So we'll be watching out if it can sustain above 1700 levels, then it becomes a trend change. Otherwise, we should be again expecting some bit of a sideways consolidation. And then maybe in the next attempt it can cross 1700. So for now, 1700, 1730 would be a stiff resistance. So would be an avoid as such. And anyways, if it opens with a gap up, the risk reward goes off. Tata Chemicals on the other hand has been not been able to break out about that 1,000 mark with say a lot of momentum. We've seen almost 5 to 7 attempts over the last 6 to 8 months around that 1,050 mark, and every time it goes above it sees a flip back. And even today we could see a flip back closer to 1,050. So would wait for some more time. The momentum is not strong. The volumes are not picking up on the breakout. The next time it sustains about 1,050, 1,070, that would be the time to actually buy it.
Okay. 1,600 rupees for Indigo. We can easily actually move to more interesting mid-cap stocks, and that is IRFC. Kunal, 30% up in last 1 week. 30%.
So I think IRFC, IRCON, both of these stocks have seen the spike in the very recent last two weeks. I think if I'm not wrong, IRFC started this rally from 32 or 34 levels 2 weeks back, and yesterday the stock managed to break past about that 50 levels for the first time. Excellent volumes for the stock, consistent price uptrend for IRFC, and I think this is what I think if I'm not wrong, even stocks like RVNL had showed in 2022, in good part of 2022, where the stock had shown a periodic rally of 40%, 50% jump in a very short span of time, then a 3 months of consolidation, and then 3 levels of breakouts which we've seen for RVNL in the last 1.5 odd year. I would probably sense that similar breakouts could be seen for the other two names, IRCON as well as IRFC. Both of them are looking attractive. I was also mentioning that IRCTC, which has been a big underperforming stock, that's also picked up pace marginally from 620 levels to 660 plus.
Okay. Devan bhai, how long will this party in railway stocks continue? I mean, these are businesses which are long cycle businesses. These are businesses which are 10-12% in terms of margin. These are not consumer businesses which are insulated to commodity pricing. Do you think at the current juncture, railway stocks and defense stocks which are commanding P multiple of consumer stocks is more like a euphoric bubble?
I don't know euphoric bubble, but I think definitely market is running much ahead of its time, I guess, and that is a reality. Of course, I think there are positive news flows which are coming in. You have got 508 railway stations coming up, 25,000 crore worth of rupees being spent. At the same time, I think the entire new order book position getting generated from the railway segment for most of the companies who are the suppliers. Investors probably, I think, are not very mindful about the situation that I think these businesses come with a very, very tight margin. And if you have any slippages for any reason, in some quarters as well, probably I think it is going to have the impact on the profits of the companies in those quarters. But that's where I think the market would probably be, because at this point of time, capital goods segments, railways, defense, all these segments are generating significantly high amount of order book positions for most of the companies. And as a result of which, I think the investors are buying much in advance at this point of time. I would definitely remain cautious, would not probably, I think, participate immediately into many of these companies. Maybe the market gives you correction of sharper degrees, which we saw in February and March of this calendar year. Similar such kind of, I think, corrections, if at all market gives in, then probably I think that would be the right time to buy into these companies, because the fundamentals are going to shape up over a longer period of time for sure. And any price correction would be a meaningful margin of safety for the investors to buy into at lower ends of the price.
Okay. What happens to Adani Green after the QI deal, Devan bhai?
I guess I think the company is basically simultaneously bringing in the new investors, capitalizing the portfolio of all the respective companies within the infrastructure space. And that to me, I think sounds really positive, because on one side you have got at a group level 60,000 crore worth of EBITDA making a possibility in the current year based on the run rate that we are experiencing. On the other side, you have got around 225,000 crore worth of debt. And systematically, if you are bringing down the debt component even through the capital infusion, along with the generation of higher amount of cash in the business, I think to me it sounds good music to ears. Basically, that the company is basically becoming more financially disciplined hereafter. And that's where probably one can keep an eye on respective companies in the portfolio of Adani. So we remain reasonably confident about the prospects going forward for most of the infrastructure businesses, and in particular the ones which are operated by Adani. So we would remain invested, but buying afresh, I think one will definitely look at in an individual company specific basis.
Devin, I'm sure everyone's curious to know what your top recommendations are within the broader markets. I'm sure that there's been a lot of opportunities. So what is it that you've been picking up?
So we continue to like some of the large cap companies because we believe that India's story is going to grow bigger. It is going to benefit some of the larger companies more at this point of time. Not that the mid and small size companies will not get benefited, but they are largely getting overpriced in the market largely because of the demand supply side situation of the stocks in the market. So as a result of which, I think they are getting relatively more expensive. Whereas the large cap companies, say for example in banking and finance space, companies like HDFC Bank continues to be available at a valuation which is compelling at this point of time. Given the potential that the size of the balance sheet getting doubled in next 3.5, 4.5 year time, I would think that I think this kind of businesses probably would bring in a lot of new investors, some of the large investors into these companies, and that is where probably I think one can argue for buying into the large cap companies like HDFC Bank. Similarly, I think even the companies like Reliance, which is promising to unfold the valuation gain because of the separate listing of different businesses going forward. To me, I think it is available at a valuation which is far more attractive than before. You can also same way argue, I think the companies like Bajaj Finance, Bajaj Finserv, there the potential of the business is also high and at the same time the execution is also matching up with the potential. So where we believe that I think the stock prices have still not performed as much as I think they should have been performing in this kind of a market. Even likes of Tata Motors in the auto space and some of the auto ancillary companies, though they may not be I think fully large cap, but maybe I think at the higher end of the mid caps, they also remain reasonably good from investment perspective. So yes, I think we believe the big is getting bigger, and that theme is going to play out well if you are holding your investment for next 5 to 10 years.
Kunal, HFCL, we don't discuss this one, but HFCL has been trending up smartly.
Yeah, Nikunj, I think yesterday was a very big breakout for HFCL, the stock. And so I'll go back to last 2 years back. I think 2021 second half, this stock was one of the best performing mid cap or tier to mid cap names to speak. So I think it moved from 25-30 rupees to at a point I think it was at 95 or 96 levels. I'm not sure whether the stock hit that 100 mark. Post that, for the last 1.5 odd year, the stock has been consolidating. So, consolidation or a time-wise correction rather than a price-wise correction is actually a good sign for such kind of names because, these stocks, they tend to change their beta nature when these stocks go into a time-wise correction rather than a major price-wise correction. So, for example, if a stock rallies from, say, 25 to 100, we ideally expect that the stock would retrace back towards 50, 55 in that leg of correction. But the stock has not done it in this last 1.5 odd years of the price correction. Yesterday was a classical sign that possibly this time-wise correction could end for HFCL. Stock showed signs of a breakout on the daily as well as on the weekly charts. So we would probably expect strong follow-through up move. And this leg of uptrend shapes up quite well. Then I would expect the stock to come back towards that 97.5 to 100 odd levels, which it had in 2021.
There is update on the new Harley launch. Will commence consumer deliveries from October. Has received more than 25,000 bookings for Harley Davidson X440. There's a new variant where they have kept the pricing extremely attractive. They're taking on RE head on. 65% plus of the booking are at the top end of the variant, which are priced at 2,69,000 plus taxes, of course. That's extra. But yeah, I mean, I don't think it will move the needle for Hero MotoCorp per se because of their significance dependence on the entry level bike. But for Hero MotoCorp, the challenge has been that now you take the clock back and say, okay, what was Hero MotoCorp? It was Hero Honda. The tie-up with Honda, it split. They were not able to build a supply chain to get the exports right, and Bajaj was able to maximize. So Honda was able to get into two-wheelers. They did not get into two-wheelers. Then they did not do anything in EV because the Honda EV brand, when the family split happened, it went to the other brother. And then now you're coming back and changing the entry level, the premium biking category. If they're able to do it, it will be an endorsement of some kind of an progress in Hero MotoCorp in terms of where they are able to experiment. For Eicher per se, well, we like it or we don't like it, they have dominated. The naysayers have come and gone, the non-believers have come and gone, but the RE platform is intact. It may be old, it may be classic, but it is a platform which is still getting appeal from the consumer. And if the last 2 quarter numbers and the last 2 month numbers of RE and Eicher numbers are anything to go by, I think I don't see a problem there. I mean, we heard from Siddharth Lal on what he had to comment on where things are moving. So Eicher has this innate, ability of surprising everybody in terms of what they've actually done.
Okay.
Kunal, we saw a bout of selling in Eicher. That's behind us now, right?
Yeah, it's behind us, and I think even Hero MotoCorp in the last 3-4 days had seen some selling, but that it's not been trend changing for both of these stocks. Whether for Hero MotoCorp on the upside because the stock was due for a breakout, it's been an underperforming stock from the two-wheeler pack and the auto pack as such. The stock had broken past about the 3,000, 3,100 levels, but could not sustain it. And I think it's now sub the 3,000 levels, 29.70, 75. The last I'd seen for Hero MotoCorp. Eicher Motors, on the other hand, the stock had fallen more than 15%. I think prior in the month of July. The stock has seen a recovery. 3,200, if I'm not wrong, is the base for Eicher Motors, where the stock has taken a bounce. So it's both ways, where Hero MotoCorp, which was due for a breakout, that stock has underperformed. Eicher Motors, the stock which had corrected and was expected to go into a further correction, has seen a bounce back. So I think that's one of the major reasons why it's very difficult to call in a trend for rest of the other auto stocks, except for a few handy names like M&M, Tata Motors, etc.
Okay, there you have it. That's the view coming in on the entire auto space. Devin, we'll let you go on that note. Thanks so much for joining in. But let's find out what the pre-open rates are indicating this morning, and around the 19,600 plus mark, and for the Sensex up about 112 points at 65,960 levels. Let's get in those mid-cap strategies going as well. And Naresh, what's looking good today within the mid-caps, your top trade?
So maintain a buy on Bandhan Bank. The stock has slowly and steadily recovered from the 215 to 20 mark. Yesterday crossed about 230 levels, which was the high around the result day where it saw a big gap down. And from that price point, if it sustains about 230, it becomes a clear-cut reversal. Opens up a target to 255 to 270 levels. Stop loss at 223.
Let's get in Kunal's top recommendation. Kunal, what's looking good from the mid-caps?
So another mid-cap IT name, rather from the IT pack, Tech Mahindra is something which I would recommend as a buy. The stock forming an inverted head and shoulder on the hourly chart. So short-term targets of 1250. Stop loss could be kept at 1160.
Okay, so those are the top mid-cap ideas coming in from our charters, but let's get you the news from across the globe as well. Tech CFO Zachary Kirkin has stepped down after 13 years with the company. He will be replaced by Vaibhav Taneja, an insider who also serves as the chief accounting officer. Shares of the automaker dipped nearly 3% after the news, but recovered to close down little less than 1% on the day. Separately, payments giant PayPal has announced the launch of its US dollar stablecoin, the first major financial technology firm to embrace digital currencies for payments and transfers. The announcement lifted its shares to nearly 2%, which in a way reflects a show of confidence in the troubled cryptocurrency industry over the last 12 months. Moving on, Paramount Global reached an agreement to sell book publisher Simon & Schuster to a private equity firm KKR for $1.62 billion. The media company announced the deal after it reported second quarter earnings on Monday. Paramount's overall revenue fell 2% to $7.6 billion, while the TV segment was dragged down by lower advertising revenue.
Moving on then, and to some domestic news. After 8 hours of deliberation, the Rajya Sabha has passed the Delhi Services Bill with 131 members voting in favour. The bill gives the central government authority over bureaucrats in the national capital. And the opposition's no confidence motion against the Narendra Modi government will come up in the parliament today. It is brought by the opposition parties, citing the recent spate of violence in Manipur. It's expected that freshly reinstated MP Rahul Gandhi will open the debate. Okay, lots lined up today on the show, but it's time for Khabar on D Street. And today, it's Kirloskar Brothers that will be in the spotlight. The company is expected to win a commercial order from the US. Let's understand a little bit more about the size of that, the plans for the company to launch some value-added products for the international business as well, and what else is going to keep the stock in focus. We've got Sharad, as always, joining in with all that Khabar. Sharad.
Well, yes, in focus, we are having Kirloskar Brothers, and what we are hearing from the street is that the company is expected to win a large commercial order for pumps coming from the US markets. Now, also, there will be some new launches coming in the value-added segment when it comes for the international business. Now, the street is expecting that re-rating is expected to kick in for the Kirloskar Group, and also the theme of capex coming in for the ancillaries is at play. Now, the stock itself has almost tripled from the March lows itself, and looking ahead, especially on the outlook front, it's expected that the overall capacity utilization is expected to be around 60 to 70% on a consolidated basis. And recently the management commentary also came where they stated that the Indian business, the domestic business, is expected to grow between 6 to 7%. Apart from that, channel checks suggest that a good inquiry is being seen, especially in the industrial pump market currently, and the demand for the oil and gas related pumps is also very strong.
Okay, thanks Sharad for joining us. We were just flashing for you on the screen how the block for Inox Wind has also happened. That is something that also we told you in Khabar, and that seems to have materialized for now. But shifting focus to what are the other stocks on the editor's radar, listen in to the take coming in from Nikunj.
Could Tech Mahindra be the special situation stock of 2023? That's what markets are betting on. Now, how do you understand that? Well, the only way to understand is that who are the people who are running the company and what is the new talent acquisition which is happening. We know that the CP Gurnani era is changing. There is a new CEO. Now, the media is also reporting that there is a new COO. So, Morgan Stanley has got a comment based on the media report that if there is a new CEO and if there is a new COO, which is Chief Operating Officer, could that combo be the turnaround combo for Tech Mahindra? This is one company of the Mahindra group which frankly has not turned around. It has a lot of potential, and Tech Mahindra was never in the big boy league. It was never in the top 4 or 5 in terms of the size, in terms of the margins. Can it be the turnaround candidate? Do they have the necessary tailwinds right now? So it's assumption. There is no proof. Numbers were good, but now can there be a change at play for Tech Mahindra? Very few companies, have that kind of a positioning, Aman. Now you think about it. Salil Parekh, Vishal Sikka, and the growth trajectory of Infosys, entirely different. Similarly, you look at Rajesh Gopinathan and Chandra when he was running TCS, the growth trajectory has been entirely different. In the case of Wipro also, when the current CEO Henry just came in, there was a big change which he was able to brought about, but then again Wipro has fallen flat. So there are a lot of these individual factors which also matter in a sector like IT. So with Tech Mahindra, I think that really could be the case. Could that really be the surprise candidate for the Mahindra group? That time will only tell, but are they putting up the building blocks, and is the valuations good enough? That is there a probability? See, I don't know about possibility. We only work in the realm of probability. Is there a probability? I will not rule that one out.
Okay, so Tech Mahindra, that's the stock on editor's radar. But what are the calls coming in at the index level of our technical experts? Let's take a look at what they are suggesting to do for the index at this point of time. Seems to be a consensus hold, at least that's the view coming in from Kunal as well as Kush, while Naresh believes that there's no trade for now, so sit on the sidelines. So a consensus hold coming in for Nifty. Is that the case for Nifty Bank as well? Yes, seems to be the case. You have a hold from Kunal and Kush, while Naresh believes just sitting on the sideline is the best strategy.
Okay, let's go back to Nifty once again. And Kunal, will the bias be up or down? Okay, 19,800 is the roof. Will the bias for next couple of days for the Nifty or Bank Nifty up or down?
It'll still be up. It'll still be upside, but then I would not expect too much of a movement as well as price gain for the index unless there is some event which plays out for the indices. But then looking at the structure of the charts, the option chain, I don't expect the index to cross 19,650 at max on the upside. Maybe 19,700 as a stretch on an intraday basis, but then I think 19,650 at max on the spot levels Nifty is something which I would expect.
You're almost there, Kunal. I mean, which means that if you add another 100 points on the Nifty today, if it adds, you'll go short.
I'll book profits on the longs.
You'll not go short?
No.
When will you go short and why will you go short?
So a short has to be created if we retest that 19,500 mark on the downside. So we managed to break it once, we bounced back from those levels. If we retest and break that 9,500 mark, that's a strong confirmation that the trends have reversed for the indices. So only a break below that previous major support is something where I will go short.
Okay. Rulesh, are we going through that patch what we were discussing yesterday, that markets really could be in a no trade zone? You know, sometimes you can see a trend, sometimes you cannot see a trend. I mean, you can always find a 100-point Nifty trade and a 150-point, 200-point bank Nifty trade, but is one better off just being on the sidelines?
So on the index, we've had a move which has continued in a one way. We are seeing the first signs of the momentum waning off across the indices, at least on the Nifty and the bank Nifty. Now the case is, we'll see this move. We recovered from 19,300, 400 to 19,600. We could go towards 19,700, 800. But the momentum, the trend has been weakened. So in that situation, you want to be out, wait for the next fresh trend, wherein after a consolidation, say we spend some time around this 19,300, 800 levels, and then eventually if we break either of the two price points, that is the point where you want to participate. In this scenario, what could happen is we'll have slow moves on the upside, slow moves on the downside, not a trending move, a consolidation phase. And in that period, if you are continuing to see strength on the broader markets as well as stock specific moves, I would prefer more on the stock specific side, because the risk reward in the current scenario ends up being 1:1. So you have a 100-pointer stop loss and a 120-point target. So that's not the place you want to trade.
Okay, that's not the place where you want to trade. 2 minutes to go. Let's look at some of the pre-open rates right now. And within the pre-open rates, well, any big news yesterday? Policy Bazaar. Any big upgrade, downgrades? Not really too much, but Gland Pharma, they deserve a special mention. So Policy Bazaar 818. Let's look at Gland Pharma. 1,500 rupees for Gland Pharma. You know, in this bull market, when you deliver, and after months and months of underperformance, then you know it's the rising tide phenomenon which will be at play. Similarly, in a downtrend, if you miss the mark lightly also, the stocks will get punished. So that kind of market we are in, where good news will get magnified, especially if the stock has underperformed, and bad news in a sense will get ignored. And that's really happened, if you frankly ask me, let's say in case of a lot of IT stocks where I didn't like the numbers. The numbers were not great, but IT is still not really fallen flat. You also want to look at HFCL, one of the top traded counter yesterday. Let's not lose sight of Zomato, because it's sold off in the second half of trade. His stock settling at 98, just below 100 rupees. So a minute to go, and could be a lazy Tuesday of trade. Nothing large in terms of a trend, nothing big in terms of a trigger, nothing special in terms of a news driver. FIs are selling, so what? Yeah, they're selling. Yeah, I know it. So what? That's my point. Why? Because DI versus FI in last 8 days is actually neutral, split right in the middle. One side is selling, other side is saying, thank you, we've been wanting to buy stocks. FI versus DI on your screen, FI is 10440, DI is 10860. So FI versus DI, I think we are in a very neutralish kind of in zone in terms of where the market setup right now is. Not too many newsmakers, like I said. Let's look at Max Healthcare. Let's look at Adani Group of stocks. That now that the QIA deal is official, the storm in a sense for Adani Group of stocks clearly has come and gone. GQG on some Adani Group of stocks. QIA has come into Adani Green. So very interesting move in terms of what's happening in Adani Group of stocks. 10 seconds to go, and I'll let the screen do all the talking here, because it's not a morning where you actually have too many newsmakers frankly, which will generate upside momentum. So let me just load up my screen so that I can bring our viewers up to speed with the first pre-open trades also. And seconds from now, and there you go. It's a good start for benchmark indices. It's a decent start for the market breadth, and a lot of green on the screen. Gland Pharma, Policy Bazaar, NTPC, Hero MotoCorp. These are some of the newsmakers today. Gland Pharma 7%, Policy Bazaar of PB Fintech up 2%, NTPC 219 rupees, and Tata Motors is giving Hero MotoCorp some company. So not a rara start for any of the big heavyweights, but there is a lot of green on the screen. The breadth, both in terms of small cap, mid cap, Sensex, Nifty, all of them are now trading with a positive bias.
Okay, all right. So it's been a decent start, but let me just start with some of the laggards as well. Olectra Green Tech is a results candidate, starts with a cut of around 7 to 8%. Ditto can be said for Rainbow Healthcare as well as Tata Chemicals. That's starting on the back foot as well. The street is not liking the kind of pricing pressure that entire vertical is going through. Paytm is the other one which has started with a bit of a cut, and Sobha Industries is also something on my radar. On the gaining side, we already highlighted Gland Pharma, which has done a stellar number. That's the reason Axis Capital has actually upgraded the stock all the way to add from a reduce. There's an upgrade coming in from Kotak Securities as well, and that's pretty much percolating in the stock price. BEML, which has bagged a 3,000 crore order for Metro, is higher by 5%. IRFC is chugging along nicely. You also have Indigo Paints, a result reaction. Policy Bazaar, as Nikunj highlighted, and then other names like Qatar and Pharma Sector also make it to the list. But the good news is all the sectors are trading in the green today. So metals may be on the bit of a back foot on account of that China data disappointing. But other than that, it's a sea of green, Aman.
Yeah, PSU banks, pharma, energy, they're all leading the way. Let's get in a take from Naresh as to what he makes of the market open. We're holding out convincingly above the 19,600 mark. Naresh, breadth in favor of the gainers. What is your first trade?
So the breadth is still in good state, but the market, the index has not moved up with a big gap up given the closing on US markets yesterday. So the view remains same, stock specific view. Continue like Indecent Bank, that could be a stock which could take a move in leadership space in the banking